Welcome to TheoTrade. This is Don Kaufman. It's May 12th, 2023. Minutes to go to the cash close here on this Friday afternoon. S&P's off just marginally on the week. However, the market is threatening to break lower as the tech bid sours. I am going to explain that and much more here on this weekend update. You know, you look at the marketplace to begin with here, and you're like, what tech bid souring? This thing is just incredibly resilient. I'm going to show you exactly what I mean, and I'll actually kind of take you through step by step about the tech bid and what it means for the broader marketplace. Got to tell you, you know, you look at this marketplace as the range, it just will not fade. 6 weeks, the exact same 100-point movement, basically 4,100, 4,200, back and forth. And again, we are 6 weeks into it. But there has been, again, some change inside of the broader tape. And we're going to show that here momentarily. First and foremost, when I start talking about the range, and I talked about this extensively last weekend, and quite frankly, last weekend, I even talked about like this has got to be it. This is going to be the week that we break the range. Let me tell you, we did not break the range. I got to tell you, I'm a little disappointed on that particular front. Not CPI, not Fed speak, not debt ceiling speak can break this range. But I want to, before I even get into this, I want to reiterate, the longer that we are in the range, the more dangerous it's going to be when we break the range. Why? Oh, this is just going to be pent up aggression. Look, it just comes down to gamma risk. The longer you're in a particular range, like we're boxed in here in this 100-point range, what occurs is a accumulation of open interest, okay? That obviously relates to the options marketplace. Options open interest starts to grow, and all of that open interest, for the most part, puts the risk, right here inside, okay, of this 100-point range. The longer you're in the range, obviously, the greater, of course, the open interest gets. So what you get is, well, what I term a situation is coming to a head. The risk continues to build, and when we eventually do just pop out of the range, whether it's higher or lower. And again, I don't mind that we're towards the lower edge of this. I'll talk about directional bias here in just a moment. Whether we're at the upper edge or the lower edge wouldn't make a difference. When we pop out of the range, the amount of open interest causes, a tremendous hedging trade. So imagine that you start crossing out of this range and you somewhere right here at that 46, all of a sudden, bam, the markets explode lower. Everybody's server turns on and starts to hedge with the dynamic of the marketplace. And it's something, again, I just wanted to reiterate, because here we are, we're 6 weeks, same range. If you are a trader selling premium, you got to be a little nervous right now. You got to be nervous because you have to be rather constrained in what you do. Too much allocation, and it doesn't matter whether you're bullish or bearish. Okay, look, when we come out of this range, somebody's going to be wrong, and it's going to be a little violence again inside of the trade. So 6 weeks, same range. Next, single stock risk in the S&P 500. This is something that I've been talking about quite extensively lately, is when you start looking at different sectors. Okay, the sectors that matter, the same old sectors, the financials, they're down 7% year-to-date basis. Also with the financials, I want to bring this into scope. The financials almost hit the lower edge of the expected move this week. The other major sector, the energy sector did hit its lower edge of the expected move. Okay, so why do I say, well, single stock risk in the S&P 500? Because what has transpired, a lot of people are going to miss this, right? So energy sector is down 7%. The financial sector is down just over 7%. And what do you got sustaining the whole marketplace? the QQQ. But when you start looking at Nasdaq stocks, there's only a handful of them. I mean, again, it's the usual suspects. It's your Microsoft, right? It's your Apple, right? It's your Amazon's got a little bit of a bid under it. It's your Google. Look at Google this week. Oh, the big bid under Google. We'll talk about that again in a moment. It's your Meta. Of course, Tesla plays a role and a critical role in NVIDIA. Mega market cap. I just covered, right? And those symbols, I just covered where your single stock risk, okay, would lie. And the point of me bringing this up is diversification in the S&P 500. Does it really exist if Apple, for example, were to sell off by, let's say, 30%? Something material happens, okay, whether it's Apple, any of these. The single stock risk, okay, is being absorbed by the entire S&P 500 because the other major sectors have already been dropped to their knees. I mean, basically, you've got, the QQQ that's up, what, almost 23% year-to-date basis. Okay, if the Qs were to turn around and sell off really to any degree, it's not just about weakness in the S&P. Okay, it's about other sectors that just they're not carrying their weight. And again, they've been basically demolished. So when you're looking at this from a market capitalization perspective, the way I really want you to think about this is in terms of market cap. Let's go look at JP Morgan, for example, okay, the biggest of the big in terms of a bank. It's under $400 billion market cap. Now, in the list of some of the usual suspects that I mentioned, if you look at stuff like Meta, right, Meta's now it's back to $600 billion market cap. $500 billion market cap inside of Tesla, NVIDIA, okay, it's clear over 700 billion. What else you got? You're not going to tell me Amazon, Google, right? All right, the weakest in terms of the market caps of these monsters is basically Tesla. And that is shocking to say the least, because at that point, JP Morgan, which is your biggest bank, isn't even really on the radar screen. And it makes a lot of sense when you start looking again, what you've seen in the last, okay, all right, in the last few months is, again, JP Morgan, the financials, they have not materialized any gains. Their market cap has been greatly diminished versus, of course, tech. Okay, people, it is the world according to tech. Now, to continue on with that, how much longer can tech hold the markets together? Now, the reason I'm asking that question, you're seeing like we're coming into the cash close here with minutes to go. The S&Ps have a wild bid, but here's something maybe that you're not aware of. I want you to take a look, okay? Not so much the Nasdaq, but we're going to look at individual stocks like Microsoft, okay? And we're going to go to auto expected moves. What auto expected moves basically is, it's how, okay, the option market cap, the option marketplace handicaps risk. Take a look at Microsoft. Really, what do we have here for the most part this week? Unchanged. It's actually going to finish the week mildly lower. But bear with me for a second, okay? Take a look at Apple. Where's Apple going to finish the week? Looks almost identical to Microsoft. Not done. Let's cruise over to Meta, right? Meta, where's it going to finish the week? Massively unchanged, right? So we just covered Microsoft and Apple and Meta. Let's go take a look at Tesla. Tesla, it's a heavyweight in here. Where's it actually going to finish the week? By the way, check out just today's trade. Lower. All right, just some wild trade, complete reversal inside of Tesla today. It's actually going to finish the week mildly lower than we have NVIDIA. Where's NVIDIA going to finish the week? Mildly lower. What I mean in the title of this weekend's update, that the markets threaten to break lower as the tech bid sours, is exactly that. So how, for a second, can the QQQ, this is the Nasdaq 100, finish the week higher? And the answer is, well, okay, if the big tech stocks, the bid sours, right? Meaning that nobody's just coming in and buying. They're not necessarily selling them, but they're definitely not buying them. The market this week, it's all about Google and Amazon. That's it. Okay, the entire bid in the S&P 500, okay, it's not coming out of the financials. The financials almost hit the lower edge of the expected move. What, the energy sector? It did hit the lower edge of the expected move. I just showed you in the monsters of tech that basically none of them moved except for Amazon, okay, and Google. And I got to tell you, Google unto itself, this is almost 3 sigma move. Google is the reason that the entire marketplace held it together. That's what I mean. Okay, and I'm trying to imply by the markets threaten to break lower as the tech bid sours. Now, it does not imply that next week Apple's not going to fly. I can't see that, right? I can't see like, oh, it's overbought, it's oversold. Look, like nobody wanted to actually come in here and say, I really got to buy that, right? It's just not happening right now. This is going to be very interesting to see next week. It's not so much about like news. Look, we can talk about catalysts and news till we are blue in the face. If you want to look at next week, okay, oh, come on. Yes, there's always fun-filled reports. We're going to hear about, the US Treasury default. That's going to be exciting, and that's actually the next topic of conversation over here. But every catalyst has been moving markets. Let's go and talk a little bit about a bull-bear case for US Treasury default, because people, there's just all kinds of rumors flying about this. Look, here's the bottom line, all right, about US Treasury default. I can actually argue that a default, all right, although initially might freak markets out, that the US actually defaulting could actually cause and spark an incredible rally. Sounds insane. It's not insane, okay? The Fed has a very serious issue on their hands, doesn't it? Okay? Here's the closing bell. Fed's got a serious issue on the head. The Fed is actually dealing, okay, with inflation. Even though this week's CPI report cooled off, okay, we're still sitting at what, 4.9% in the CPI. But you know what, from my perspective, takes care of CPI faster than anything? Oh, default. Because what'll happen with a default is immediately your interest rates, okay, will skyrocket. You'll look at stuff, okay, in the very near term, like TNX would explode. I mean, it could explode to 3.8 or even 4%. So imagine, if you will, okay, all of a sudden we default out here. Boom, we're sitting at 4%. Bye-bye, inflation. All of a sudden the Fed's like, that was the greatest thing that ever could have happened to us. I know it sounds extraordinarily convoluted, okay? But you can actually make a very bullish case for the marketplace because of default. Now, that bullish case might not necessarily be right off the bat, okay? But think about that. All of a sudden, everybody hears default. Nobody's spending a dime. Rates explode. Nobody buys homes. Nobody buys cars, okay? It's going to be like lockdown central of spending. And yeah, okay, that unto itself, okay, could create a reason for the Fed to turn around and not have to do anything more in terms of rate hikes. They could actually eventually talk about, decreasing rates at some point. Gotta love that one over there, right? All right. It's one of the things, though, that I wanted to bring up because people are like, well, how come the market's not freaking out yet because of the possibility of default? Well, one of two things. Either people look at this the way I do, right? Or, okay, they just basically say, they'll work it out. Could be either or, right? But again, less worry about that. Don't worry about it. What you got to worry about, some of the price action in the markets. What you really need to worry about, check this out. The next thing we're going to talk about, VVIX, Skew. One thing that has absolutely changed here is I have noticed in the backdrop here, the VVIX is climbing. Now, what the VVIX is, okay, it's the volatility index. It's a very exciting concept. VVIX, basically what it is, okay, it's volatility of VIX. And when the VVIX is climbing, and it's a pretty significant move, right? It moved from 85 to 100, but when the VVIX is actually bid, somebody's hedging, right? Trade is hedging. What is also very prevalent in this marketplace, skew is higher than it has been in a very considerable period of time, right? When I say skew is higher, like how much higher? Like, look, if you look back over like the last 10 years, and I'm actually just going to bring it up, look back over the last, 10 years, and all right, so skew is definitely kind of looks like middle of the road, but skew is very elevated versus where it has been since, okay, and I just want you to zoom in. It's very elevated since basically kind of about a year ago. It's by far and away the highest skew we've seen in the last year. And what it also indicates hedging activity. This is out of the money puts, okay, obviously being gobbled up. The implied volatility skew is heavy right now. And actually, that's one of the things that's pretty good for premium sellers. I'm not wanting to sell a huge amount of premium just yet because we haven't broken the range, but I got to tell you, the sale of premium, it is very alluring right now as risk starts to build, right? So you're stuck in this range, okay, for the last 6 weeks. Skew is starting to build. Tech just basically topped out. The only thing that really moved is Amazon and Google. Okay. Other sectors have actually broken lower. I mean, you're holding on to a marketplace, okay, by a very, very thin line over here. To get very specific in terms of levels, to break lower, let's talk about lower first. To break lower, it's not just the 41.06. We've seen 41.06. Okay. In fact, we got all the way down to, 41.11 and change today. To break lower, somewhere right around, okay, this 40.60 level. I'm just reiterating that from last weekend, somewhere around 40.60. You get below it, absolute crap storm fireworks in the marketplace. To the upside, the first major target to the upside, I want to kind of zoom out for a second to make sure that everybody is comfortable and everybody actually sees these levels, right? To the upside over here, all you're really going to need, all right, 42.11, okay, would get hit, and then we would actually explode. You start to get to the neighborhood of about 42.40, we catch fire. It's an easy shot at that point, up another 100 handles. Now, you look at this and you think, there's no way we're going to the upside, okay? Do not discount it. One thing that I want to reiterate here, just because I'm telling you like markets threaten to break lower as the tech bid sours, okay? That's right here, right now. I can't tell you, like Apple could actually catch fire again next week. It just seems like this wild rotation game. We're definitely leaning to the downside. You see skew elevated. Risk is kind of building in there, and I get it. Okay, push all of that aside for a second. I assign no bias here. Okay, I don't assign a bias because I've seen this movie too many times where you just basically channel, and all of a sudden you think you're going to break lower and boom, we explode off of it, right? There's no bias right now. Check it at the door. The only thing you know is coming out of the range is going to have some serious, serious violence in terms of the trade. It's one of the reasons you need, as a trader, to be very constrained right now. I don't care if it's 6 weeks. I don't care if you feel grossly underallocated, okay? You have to basically sit and you just kind of sputter along, sell a little premium, and when we do break range, okay, just get under your desk and look for opportunities. Get your trade on this week's profits and losses. You're going to notice there's not that much in here, and I'll tell you why there's not much in here, okay? So I'm not stepping out and firing off a whole lot of positions. I continue to build, okay, upon a few short positions that I would like to embark upon. And that basically means stuff like Microsoft. Believe me, I want to be in the short Microsoft business right now, right? And I am short Microsoft, okay? I'm looking to re-up a short inside of NVIDIA, but I am going to wait until we're through, all right, the earnings. Why am I going to wait? I got to wait like another 10 days over there because that earnings is dangerous. I've only got like 100 shares on right now, short shares. I'd like to up that to between 300 and 400 shares, but being very, very patient inside of NVIDIA. A few other major tech stocks I'm also shorting. This week, though, all I really did is I covered some calls, meaning that I closed calls for over a 50% gain. I closed out of Alibaba for 30% gain, and I had a Walmart in-out spread expire worthless. That would be the sum of the week. Look, the next thing we need to talk about here, and something I sum up every single weekend update with, the SPX, the mother of all products. As I said, you're 6 weeks into absolutely nothing. 1, 2, 3, 4, 5, 6. One of the things that's, again, I'm shocked about. See that line across your screen? Do you realize this is where the week started and that's where the week ended? For the most part, massively unchanged. You know what? It's getting a little old saying that because even last week the markets were mildly lower. This week, mildly lower. That is the S&P 500. But off of a $68 move, we didn't move anything. And again, I want to warn you, when you see movement like this, where we're just ebbing and flowing in a very, very tight range, okay, markets are like this just rubber band. And right now, okay, that rubber band is just being wound very, very tight. Okay, we come out of it, things are going to get wild. So Again, keep your hands and feet inside of the vehicle. As I said, the situation might be coming to a head. Just Skew and VVIX, okay, are a little bit dangerous. The SPX, okay, into the next week of trade. Check this out. Got 7 days to the next week of trade. It is a primary expiration. The expected move falls only mildly, but falls to about between 63 and $64. It's not set yet, wouldn't be set till 15 minutes after the cash close. So we're coming in somewhere near a $64 expected move. We just came off of a $68 expected move. So a very similar week effectively being priced in to this next week of trade. All right. I guess the question and the final question is the 7th week, is this going to do it? Okay. Are we finally going to break what has mounted to, again, an incredibly tight range? When we do, people, I'm telling you, don't get caught looking for a move higher or per se lower. If you have longer duration positions on, you're fine. Be bullish, be bearish. That's fine. It's the short duration stuff. Okay, and recognizing we are a coin flip away from a rip to the upside, okay, or a dip like you haven't felt in a significant period of time. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.